Breaking news, Gustan Cho, the Fed, post-hike. So they didn't hike, but they hinted that maybe they might be raising in 2022. That's different from 2023. Now, they didn't say for sure, but they thought maybe the environment would call for something a little sooner, and then the market went crazy yesterday, and rates went up by a good chunk, 3/8 to a half a point. And today they're coming back down. They're going back to where they were, but not fully. But the Fed is hinting to possibly moving and raising rates, or stop the tapering, stop the mortgage buying, stop throwing money into the system. Not sure any combination of all that. So they may not raise rates, but they're going to stop the tapering, which is basically putting money into the market and keeping the Treasury system with a bid in it, which keeps the rates low. So this could stop earlier. They're going to watch and see. They have inflation targets. They want to see inflation around 2%. They don't want it running at 3%. So if it's running at 2%, they may not do anything. But if it's running at 3% for the next year, they're probably going to hike the rates or do something to bring the inflation rate back down to 2%. So keeping the eye out for that. They're going to be looking at inflationary numbers going forward. That's CPI and PPI. CPI stands for Consumer Price Index. PPI stands for Producer Price Index. So if the producers are having higher prices, they usually pass it on the consumer, but the CPI directly shows you what the consumer's paying for more goods. So the consumer's the secondary effect, and probably a more accurate number how much that's going to hurt the average Joe on paying more for milk, more for gas, more for the lumber, more for everything. So the CPI is the big one to watch, but PPI is a leading indicator what CPI is going to do in general. So keep an eye out for the CPIs and the PPIs. Those are the biggest inflation technical analysis you can look at for the average Joe on the street. So look at your CPIs and PPIs. If you see it year over year, it running above 2%, expect possible hiking of interest rates. Now, they're not going to hike them that much, but they're going to slow down the economy so they can stop inflation. If inflation gets out of hand, it can really hurt the lower income people because maybe they don't own houses that are going up in value. They're renting, and now their cost of milk went up. They're not winning on the asset appreciation side. So let's say you're paying $2 more for a gallon of milk, but your house is worth $50,000 more than it was, then you don't really care. But if you're a renter and you're paying $2 more for milk and you have no assets that are going up to offset that, it hurts the lower end income people, and they have to stop that. It's not fair. So they don't want the rich to get richer and the poor to get poorer. So they want to keep a balanced economy, so they're going to slow it down if that's the case. So keep an eye out for it. If you got any questions, call me anytime at 630-915-7550, and please subscribe.